Today we're analyzing Verizon Communications Incorporated, ticker symbol VZ. Is it time to buy this crazy high dividend yielding stock for cheap, or is it just a great cashing check for the near future? Let's find out in this video. Verizon is headquartered in New York City, United States. Verizon Communications, through its subsidiaries, offers communications, technology, information and entertainment products and services to consumers, businesses and governmental entities worldwide. The consumer segment provides postpaid and prepaid service plans, internet access on notebook computers and tablets, wireless equipment including smartphones and other handsets, and wireless-enabled internet devices such as tablets and other wireless-enabled connected devices comprising smartwatches. It also provides residential fixed connectivity solutions such as internet, video and voice services, and sells network access to mobile virtual network operators all over the world. Verizon is one of the only 3 nationwide 5G providers in the US. Let's just stop rambling about it and get straight into numbers. I know you all are mostly interested in that to see if the stock is worth buying or not. The stock price currently is at $40. Looking at the 5-year history chart, we can see it has been pounding against that $60 mark. Only been able to hit it twice in the last 5 years. Since then, the stock has drastically fallen and I believe it will continue to do so. What is very interesting to me though, that when we look at this chart and when COVID started at the beginning of 2020, the stock didn't make a huge drop compared to the later drop you can see here. It only dropped from $60 down to $51.80. That's not so bad. I've seen far more devastated drops. Like, for example, this one, Rhythm Capital. You can see a huge drop when COVID broke out. Looking at this 5-year chart, it's surprising how little the COVID drop was compared to the drop we see as of very recently. From the beginning of July 2022 to the mid-October, it dropped from $51 down to $35.35. Why did this happen, you ask? I will explain that later in the video when we're gonna talk about the future and if this stock is worth buying or not. It might not be a greatest, but can be for the short term great for a dividend investor. Let's expand this 5 years into the max history. We can see it has a very long history from 1984, when the stock was only $7.62. Due to the long history, we can see how the company's been doing during recessions and economic downfalls. 3 major economic downturns come to mind: the internet bubble of 2001, the housing market crash of 2008, and the COVID pandemic, which broke out in the early 2020s. During these times, we can see huge drops in the stock market. Looking at it from a helicopter perspective, the stock went from $7.62 in 1984 to a little over $40 as of right now. When you know this, you would think this would be an awful investment. It is only a 425% increase in 40 years. But this stock stood out to me for its dividends and not its growth. Talking about the dividends has been distributed since 1984. The first dividend was 20 cents per quarter. At a stock price of $7.62 at that time, this would come down to a dividend yield of over 10%. It rose its dividend every year since this point until 1998. From there, it has been steady until 2005. From this point, Verizon made the decision to raise its dividends every year and has been doing so until the present, 2023. In this chart, you can see it a lot easier. So this increase has been going on for 18 years. Verizon is trying to become a dividend aristocrat. A company will be considered a dividend aristocrat if it raises its dividends consistently for at least the past 25 years. This means that Verizon needs to raise its dividend payouts every year consecutively, and only then they will be eligible to become a dividend aristocrat. Although this sounds like a dream, already at a dividend yield of over 6%, This also increases some of the problems. The money the company is paying out to the shareholders can't be reinvested to growth opportunities. Dividend stocks may also produce lesser capital gains because, once again, the money isn't reinvested into the company. And also, keep this in mind, dividend payments are taxable events. Now that we've talked about the price of the stock and the dividends, let's talk about the ratios, the financial ratios I use in order to investigate a company and how it's doing for the past 5 years. So these are some of the ratios that I use personally to see how a company has been performing. The payout ratio. You can see it has been around the 50% mark, which means every dollar the company makes in earnings will be paid out as dividends to its shareholders. I mentioned previously that there are issues if the company pays a lot of its earnings to its shareholders. The earnings per share, this is calculated by the net income divided by the number of shares outstanding. You can see that the last few years it's been around $4 and $5, with outsways to $7 in 2018 and $3 in 2017. Next up is the dividends per share. This has been rising steadily over the years, and as I just said, Verizon is trying to become a dividend aristocrat, so it will keep paying the high dividends plus make the payout larger than last year. In 2017, it was paying out $2.34, and in 2022, 5 years later, it paid out $2.59. This increase you can also write in percentages, the dividend growth. You can see that the dividend growth is a little above 2%, which to me is insane for a stock with an already high dividend yield. The PE ratio is the price per share divided by the earnings per share. Price divided by earnings. A high PE ratio generally indicates that the market has a higher expectation of the company's future earnings growth. Here you can see it has been declining for the past years, which could also be translated if you want to be optimistic that the stock is becoming cheaper. We will talk about this further into the video because this to me is a bit of a concern for the future of the company. The DE ratio, debt to equity ratio, takes the amount of debt there is on the balance sheet divided by the amount of equity. A number higher than 1 indicates that there's more debt than equity on the balance sheet. For me, in this day and age, it's a very important ratio. Looking at the current macroeconomic conditions, where the Fed and the ECB are quickly raising its interest rates, that the debt that will be taken on will be more expensive. You can see a little decline, so that to me is a very good indication. And last but not least, the ROE ratio, the return on equity ratio. It measures how efficiently a company is using its shareholders' equity to generate profits. It is calculated by dividing the company's net income by its shareholders' equity. This is well above the 20% mark, which indicates that the business is really knowing what they're doing and how to use their money to make a profit. All in all, the ratios look good to me. The thing that does concern me a bit though is the amount of debt it has. Though the interest rates are high, Verizon still knows how to get the maximum amount of return on its equity. A quick side note, on this channel we try to focus on high yielding dividend stocks so we can eventually give us the freedom to live off of our dividend income to focus on other things in life than just work. We work to live, not live to work. So if you like this kind of content, subscribe, it's totally free and it would help me out a lot. Let's get back into the video and now we're going to talk about the future of the company. Coming back to the question I asked earlier in the video, the stock dropped significantly the last few months. How did this happen and will this continue? Well, this question can be answered with multiple answers, but one could be is that they are falling behind and competing against other major businesses. There's a tiny group that dominates the telecommunication market. at&t, T-Mobile and Verizon. Verizon though is struggling with its subscriber growth throughout the year. Verizon lost 16,000 subscribers in just 9 months. Compare this to at&t and T-Mobile, both added more than 1 million subscribers. Wireless networks are price competitive, so subscriber growth is crucial in driving revenue growth. Verizon stalling in subscribers could foreshadow weak growth down the road, and is probably at least a reason why the stock has fallen out of favor on Wall Street. As of the near future, we can see here that even in a year where operating profits are down year to date from 31 billion to 28 billion, and increased capital spending has further reduced free cash flow, but Verizon still has 4.3 billion in cash left after paying the dividend. Investors like us need to watch and see if this free cash flow continues dropping in the quarters ahead. But it seems that the dividend faces no danger at present. So you can all sleep well if you decide to buy the stock with a almost 7% dividend yield. Now, is it time to buy the stock for cheap? Whether Verizon is a buy today depends on your situations. For example, investors looking to maximize income on their investments can buy Verizon for its well-funded dividend. But it's a bit more challenging question for a total return, which includes a rising share price. You can see huge drops along this line. Verizon is trading at the price to earning ratio, the PE ratio, of just 8, well below its typical valuation over the past decade of around 13. The goal of this video is not to convince you to buy this stock, but to give you some basic information and data on this company so you can make a better decision on how to approach this company and give you a little head start when you do decide to look further into the company. Thank you so much for watching. If you found this video helpful and informative, please consider subscribing to the channel for more investing tips and strategies. Your support helps me out a lot in creating valuable content for you guys. And don't forget to hit the notification bell to never miss an update. Please note that I am not a financial advisor. I work at an accounting firm with numbers and money. Of course, always make sure to do your own homework. And if you'd like to discuss any stock or this stock, leave a comment down below. And I hope to see you in the next video. Take care.